Stagflation, the worst of many worlds. Economic stagnation, high inflation, and rising unemployment. Stagflation historically leads to lower returns on investments. So what can you do to protect yourself and your wealth? Historically, gold performs very well in periods of stagflation. Investors exit the standard publicly traded investments like stocks, bonds, and other paper assets looking for safety and stability. When stagflation sets in, inflation gets sticky, and as the central banks continue to tighten or pause, tangible commodities such as precious metals, base metals, are a more reliant place to park your investment capital. Gold is not only a safer investment, it surges in price in times of stagflation. Precious metals, more specifically gold, hit their highest value in the hard economic times of the 1970s and early 80s. Between 1971 to 1982, gold increased 2,200%. The stagflation pockets in this period were 1974 to 75 and 1978 to 1982. The S&P 500 fell 40% during the stagflation event of 1974. U.S. Treasuries and government bonds gave negative returns when adjusted for inflation. In times of stagflation, real assets, or sometimes known as hard assets, such as commodities, are the best performing assets. History does not repeat, but rhymes, and if past is prologue, then our last analog for stagflation is the 1970s, for which the U.S. experienced multiple waves of inflation. Each successive wave was more violent than the last. The Federal Reserve is using the same tools as in the 1970s, quantitative tightening. In the 1970s, the Federal Reserve applied these tools in a more aggressive way, resulting in double-digit interest rate hikes. This was a painful period for the average American and investor. All along the way, gold experienced the greatest bull market in its history. This next possible period of stagflation could be even longer and possibly lead to another bull market for this yellow metal. There is a big difference between the 1970s economy and our present one. The main one being the nation's national debt to GDP ratio. In the 1970s, the U.S. debt to GDP ratio was 32 to 35%. Bear in mind the Federal Reserve during the 1970s had to raise interest rates to double digits. In retrospect, the ability for the U.S. government to service the national debt during the massive interest rate hikes in the 1970s and 80s was far easier than our present economic environment, and that is just the national debt. Household and corporate debt is in for the same shock as those rates roll over. As the Federal Reserve Chairman stated many times in 2022, there's going to be pain. Gold is an excellent hedge in good times, but a crucial hedge in times of stagflation. The forces facing the U.S. as well as the world are far more intense than they were in the last stagflation cycle of the 1970s and 1980s. Historically, gold and other precious metals stand strong against these challenging economic headwinds. Precious metals are essentially wealth insurance against losses that are felt elsewhere. Gold and other precious metals won't go bankrupt on you, and central banks cannot print more or manipulate its supply. To learn more about gold and silver investing, see the links in the video description to access the many gold investment guides from the best gold IRA and precious metals investment companies that we have personally researched and vetted. Get started today by attending a free gold and silver educational webinar from Augusta Precious Metals. Click the link in the video description.